Greetings, friends. Welcome back. We're going to learn today about options learning, hedge against derivative holdings. Right. So many of members have uh, asked me personal questions, or how do I reduce the loss? So stock market is all about profits and losses. So you know well about it. So one cannot make consistent profit, but yes, loss can be reduced. So we are going to learn about how to reduce the losses. It's not about making a profit, but reducing the losses. So it might be a quite interesting today. So it's a short video, but it will give most of good inputs for your derivative holdings. Right? Let's go ahead and understand more in detail. So options are basically used for reducing the risk up to 70 to 80%, which we'll learn today. And most of your reducing risk strategy will be based on selling the options. Right? So we will learn how to do that. So I have also given you a basic understanding about a covered call strategy. That is a basic one about an option learning. So if you have not gone through that video, I've just posted a link below this description. You can get into our previous video about covered strategy that will give you a basic idea about it. So let's get into an options basic understanding on what is in the money call, what is out the money call, uh, what is out the money put, and what is in the money put. So this is the structure of an NSE site. When you go as an option chain, you can find, assuming if the stock is trading at 10,700, then this becomes your in the money call, and this is called as out the money call. And when the stock is trading at, Nifty is trading at 10,700, and this put is called out OTM put and in the money put. So today's workings will be based on this. So I want you to understand this whole snapshot clear, so that the upcoming chart will be useful for you to get into the strategy options. So this is one assumption which I'm taking. So I'm assuming market is bullish. So this is not a trading strategy. This is not a trading call. Disclaimer, please understand. I'm just giving this you for a learning understanding, right? Assuming Nifty is trading at 10,000 rupees, 10,000 strike. So I'm willing to buy in the futures long. I wish to take a long in future, but I need to protect my downside risk. So if that is the case, what you can do is buy Nifty futures at 10,000, sell in the money call, which is 9,800 to 9,850. So you can see this is in the money. So which means assuming 10,000, this yellow color shade is called in the money for the call. So that call I'll going to sell. Why in the money call? Because you will be staying in the option is all about time decay. So it is important to pick up those strike which has a good volume and time decay as well. So in case if you don't have much of the corpus with you or a capital investment, then you can directly take this into a option strategy. Then you can buy call 10,000 strike and sell same call in the money 9850 to 9950, so that at least you stay in power of time. This strategy is used to protect downside risk up to 70 to 80%, and this we will see how it works now. In case if you're bearish in futures, directly you can sell in the money put, you can sell 10,200, 10,250, or if you have a low capital, then you can buy in direct option, buy put 10,000 strike and sell put 10,200 strike to protect your risk for the upside. So now let's understand how this works. So you should pick up, if you are using this for stocks or any other good volume based stock, then you should understand these 4 parameters. The stock should have a good liquidity, preferable daily average volume above 3 to 4 lakhs. Only then the option will be useful for you. Open interest above 300 plus, preferable above 500 plus. If you're highly bullish, choose OTM call option. If your neutral, choice at the money call options, right? So you know what is OTM and what is at them. If not, please review my previous video so that you'll understand better. So let's understand payoff in option Opstra. So I'm just showing you what I'm going to take a call today. So let's understand this. So Nifty buying at, say it's an option. So convert this in the future first. So I'm buying at 10,000. Change this as 10,000. Right. So add the position. Then use the option. So 9,850, and it's going to be sell one lot, price at option is right. So add the position. Now if you can look at, it has come. Now we'll have to understand what is the Greek for this option. So you can see the Greek here. So delta is 57.6. So I'll make this and I'll give you this understanding shortly. So if you can see the time, theta is nothing but a time value which is favorable in our trade. So now let's understand the break even of this trade should be 9727, which means you can hold till downside up to 9727 to protect your losses, right? So the maximum profit what you can earn is up to 6% of this trade, and net credit can be 20,531. In case if it closes above this 9,850. So now first let's understand, you forget about what is going to be credit. So first let's understand how it's going to help us in reducing our losses. Now assuming market, you took a long position and the market have corrected 200 points down. So that is your stop loss. 9,800 is stop loss. So assuming your 9,800 stop is triggered. So which means you're exiting at 9,000. Let's see what is a minus. So 15,000 rupees is a minus, right? So when 200 rupees corrected here, so you can see 273. So we saw the Greek as 57 around, right? Delta value. If it's a 57 is a delta value, 0.57 into 200 points, which refers 114 points will be reduced from this option. So 273 minus 114, which will be around 159 to 160 range. This option value will be 160 range. So when it is a 160 range, so what is your profit? 8,531. So your overall negativity is only 6,468. So now if you can see, if both trade exited simultaneously, you have reduced your losses from 15,000 rupees to 6,000 rupees, which means almost 60 to 70% you have reduced your losses from this trade. So sometimes if you can see the volume, this is more better. If it is at 40, volatility is more high, this may be at 140 or 130 kind of range. So if you see that is a range, then probably your profit is almost 10,000 rupees. So which means your loss is very minimum. So this is how the options can be used to reduce your losses. So we are only talking about the risk management. We're not talking about any profitability now. This is only about the risk management. How you can reduce your risk in working towards a derivatives, right? So to know how much you have to invest for this trade, so you can get into an F&O margin calculator of Zerodha. You can see how much you need to pay for this money. I already used this NFO. You can select the NFO, futures, options. Once you select, I have already done this. So total margin required for this trade is 2,70,000. If you have a 3 lakh rupees corpus, you can do this trade, right? So make sure it is being used simultaneously for shorting the position as well. So you can try this and see how it works for you, and let me know the result of the same. So do not take higher risk into this trading with this unless you have a proper understanding about an option. Learn, understand, then you start trading into this. Well, hope you have understood this, and in case you have any further clarification, put your thought in the comments, or anything which you feel required more in detail, please put me in the comment. I will definitely look into the comment and understand whether you need what kind of a video next time. Right? Thank you very much for your time. Please stay connected. Thank you.